just to give you an idea. So now audit. Let's start with the very beginning. Again, the thing that I want you to do is the assertion levels. Assertion level in the level of transactions and assertions in the level of presentation of financial reports. That will be the important thing. Let's go back to this to those slides with the assertions, because again, I want you to know those ones, so you can feel comfortable with this. With the exact explanation, what means occurrence on the level of transaction and events, completeness, authorization, accuracy, cutoff, classification, presentation. That's for the transaction and events, and then for the financial statements, for the account balances at the end of the period. As you can see, this is the transaction at the time when the transaction happened, and this is the account balances at the reporting date and the related disclosure to that accounting balances, from where that account balance came from. Is it accurate? So we're gonna chase, is it about the existence? Is it asset? Where is it recorded? Rights of the obligation. Do you have a contract? You don't have a contract? Completeness, accuracy, valuation, allocation, classification, and presentation. All those things are going to be tested during the audit. So now let's go to the outcomes of the audit. I know in the very beginning we're talking about the outcomes of the audit, which is not fair thing. I always wonder why we're doing this in audit. But at the end of the audit, when the auditor prepared that audit report, has 1, 2, 3, 4 options. First option is to issue unqualified report. Unqualified report means because there's no financial statements are free of error or any material misstatements. They might be misstatements, but those misstatements are not material. Do you understand this? If there's some misstatements, but those misstatements are not material, you still issue unqualified report. So in that case, means that the auditor does not find it necessary to qualify his or her opinion about the fairness of the financial statements. Why? Because there's no, they're free of material mistakes, misstatements. Second one, there's some material misstatements. Qualified report is that misstatements, the statement contain misstatements that the auditor consider material. Now, if the management is willing to change those ones and correct the misstatements, then we're going to unqualify. But if the management refused to change those ones, we should qualify. Adverse is when we have now there are some misstatements, those are material, and those going to affect the interpretation of financial statements. So whoever read the financial statements, they're going to change their opinion. That's not good. That's going to affect their opinion. So for that reason, we issue adverse, and disclaimer is the worst case scenario. This is the worst case scenario. Sometimes auditor, instead of issue disclaimer, they just walk away from the audit. So that's with the very basic thing. Now with the starting with the audit, having those things in mind, when you're starting the audit, we already saw we have two options here. One option is to have a new client. The other option is to have the existing clients, repeating clients. Again, those are the two scenarios. So that's why when you get the CPA case, be careful and pay attention on what kind of client you have. In terms of is it repeating client, is it the brand new client? If it's a repeating client, then it's easy, a little bit more easy. I'm not saying the completely easy, but a little bit more easy. If it's the new client, then you have to have a little bit more preparation up front. So those are the two scenarios. Client, when we have a new client, we're going to accept the client. We're going to go with the preliminary engagement activity, and we're going to plan the audit. So again, new client, we have to assess a few things. Once we do that, then we go to the next situation when we have a continuous client. For continuous client, we're chasing, do we have a conflict? That's what we're doing. Is there any conflict? Did we create a too much close relationship with the client? And then we're going to start this understanding of the entity. First, we're going to issue that engagement letter. Then we're going to start working on the internal audit function. We're going to see is the internal control, how effective is the internal control, and then we're going to go with to find out is the audit committee and what's their responsibility in the audit committee. And with the audit committee responsibility here, so now on our side, once we issue this, we have to start working on the audit strategy in order to develop the audit plan. And once we start planning, we're going to start the first thing on the planning of audit is to assess the risk. Then we're going to establish the materiality. Is there multi-location? Do we need to refer to specialist? Is there any violation of the law or regulation? Which are the related party? Is there any additional value-added services that we have to provide? And we have to document all the audit plan, and prepare the audit program. And we're going to start one after another on all of those until we are comfortable and we have the audit plan. So once we have that audit plan, then we're going to start risk assessment. As you can see, the risk assessment is important part because we as an auditor, we have to understand that we have a risk that we can mitigate, and there's a not risk that there's nothing we can do about it. For that reason, by assessing the risk, we're chasing what will be the level of assertion here. Again, on the level of assertion, we're going to chase the financial statement level, individual account balances disclosure level. Again, we're going back to the first slides that we show you with the assertion level. So on the risk, what I want you to remember, we have 3 risks. Audit risk is comprised by the 3 risks. Inherent risk, which there's nothing you can do about it. Control risk, again, nothing you can do about it. And detection risk. Detection risk is the only one that you can control to some level, actually to a lot of level. Why? Because the detection risk is the one that is going to define what will be the audit work that you have to do as auditor in order to come up with the audit risk, which will be on the level that's going to give you the opportunity or give you the chances you to issue qualified, unqualified report. Again, we assessing inherent risk, we assessing control risk, and we establish the detection risk. So how are we going to establish detection? Simply by the formula. Detection risk is going to be audit risk divided by inherent risk, control risk. If those are high, detection risk is going to be high. If those are low, then detection risk is going to be the opposite. Actually, that they're working with the opposite proportion here. But again, you're chasing through this formula. Once you establish what you want to be the audit risk, what level you want to be the audit risk, then you're working out on to identify the inherent risk, control risk, and then you determine what kind of procedures you're going to do to be comfortable with the detection risk. So again, the simple thing is, if the audit risk you want to be low, and I always forget this, the risk of material misstatement is high, then detection risk has to be low to counter this high risk. So what that means is you have to put a lot of procedures in order to lower the detection risk. Detection risk is the risk that is related to the chances you to miss something on the financial statements or the transaction level or the account level on the disclosure level. So once we have those risks, then we're going to start, then the next thing is to assess the materiality. Let me see where the materiality is. Materiality should be here somewhere, but I cannot find it right now. That's talking about the fraud and how we establish the fraud. I guess materiality is not here. Let's move to the next chapter. That was chapter 4. So then the next thing is to assess the materiality through the documents and evidence. Let me see, is the materiality here? I lost this materiality. I lost it somewhere. I think should be in chapter 4. Limitation of audit risk model, overview financial assessment. It should be here somewhere, but let me find it quickly. Once we assess the internal control, that's going to help, but that's with the risk factors, knowledge. No, it's not here. And which chapter was materiality, people? Do you remember? Here, in chapter 3, and found it. In chapter 3 is the assessment of the materiality. So for the materiality, that's the next thing that I want you to remember. You have to memorize it, materiality. How you come up with the materiality and what's going to help you for the materiality. Materiality is the interpretation of materiality is the fact that is material if it's substantially likely to change the opinion of the users. It's not absolute, again, it's not black and white, it will be your judgment here. You have to come up. So first we're going to determine the overall materiality. Second, you're going to determine that determine a tolerable misstatement or performance materiality. And then we're going to evaluate the audit findings. Whatever we find from the audit is actually meeting that requirements. Again, for the materiality, easiest one is to use the net income. That with that, then we're moving to the chapter 6 was with evidence and documentation. What kind of evidence we have to gather and what kind of documentation we're going to look at, again, in order we to be comfortable of issuing the audit report or unqualified audit report. Everything again starts with the financial statements. We're going to the management assertion about each component on the transaction level and the account level. Audit procedures, which are going to confirm that everything that has been done in the company is done by the way it should be done, and the information is correct and present the right picture in the company. Then we're going to start gathering those evidence in order to find that everything that we say is the right and correct. And once we reach the conclusion, we're going to issue the audit report. Again, on the session level, on the transaction event, we're chasing all those level of assertions. And on the account balances in the related disclosure, we're chasing those one. Again, repetition of the assertions level. And gathering the evidence, how we're going to gather it, either through the reports, either from the third parties. Always remember the third party reports is more valuable than the internal reports from the company. Again, if you want to looking for the information, for where is the source that you can find it. Third parties information is more valuable than the information directly from the company. So now, having those things in mind, all those things in mind, all those chapters in mind, now we can move on to the new chapters, which I want to discuss today with you. Let me close all those chapters first, that I have it on my screen, because then that start confusing me. Once we gather those audit evidence, so the last time we did the internal control in the financial statement audit, and today, very briefly, I'm going to talk about over financial reporting. We did chapter 7 last time, and let's briefly, just very briefly, on the very beginning, I'm going to talk a little bit about this audit sampling, an overview of the application of test and of control. That's very briefly. I'm just more like gonna set up the tone for the what's coming next. So we're gonna use the statistical and non-statistical method to gather those audit sampling. The technological advantages, we have reduced the number of time of the audit, obviously. Why? Because we're running tests on the software. Once we run the test on the software, we can easily chase the amounts which are material, which are not material, and automatically we can trace them back to the accounts and to the reports. So we're going to develop in the well-controlled automatic accounting system, since we have that system, and powerful audit software, which download and examine the entire population of the data, not just sample, entire data of the. So that's why this is the relationship that you're going to have here between the audit and data analytics. Because in audit now, data analytics are only as good as the qualify for the underlying data. Often is completeness, accuracy, validity, and underlying data needs to be tested, and sampling can be effective and efficient techniques when we're using the data analytics. So what will be defined with the key concepts here will be audit sampling risk, confidence level, and tolerable and expected error that we're having. Audit sampling will be it will be in this section evaluates less than 100% of the items the population of audit relevance. So the audit sampling will be how much of the information, like client information, we're going to have access to first, and how much of that information we're going to base on our opinion on. Then the sampling risk is the risk related to we not to catch something on the, or to choose the sample which is not relevant to the client, and after that we to miss something. So there are two types of risk. Incorrect rejection, type 1. This is in the test of the internal control, and it's the risk that sample supports a conclusion that the control is not operating effectively. And the second type is the risk of the incorrect acceptance, type 2. First one is for the incorrect rejection. Second one is the incorrect acceptance. Is the test the internal control, and it's the risk that the sample supports a conclusion that control is operating effectively, when in fact it's not operating effectively. So in the first case is the test internal control, and it's the risk that the sampling supports the conclusion that control is not operating effectively, when in fact operating effectively. And the other mistake is the other risk is the opposite. In substantive testing is the risk that the sample indicates that the recorded balance is materially misstated, when in fact is not. This is for the incorrect rejection. The other one is for incorrect acceptance. Obviously, we're testing it. We assume that suppose the recording balances it's free of misstatement, where actually it's materially misstated. So again, those will be the risk of incorrect rejection, if correct or incorrect acceptance. Again, rejection is when we rejecting it, but in fact is it's everything is okay. And the second one is when we say it's okay, but in fact it's not okay. That's how simply we can put it in your head. And there's three samples. These are the three important factors when we determine the size. When we determine the size, desired level of assurance that we want. Second is acceptable the defect rate. And the last one, historical defect rate. So you can see here we're going a very, very, very in the very deep level now. I'm not gonna spend. That's the only thing that I want you to know here. And on the planning process, when we're doing the planning of the audit, is first is to determine the test objective, what we testing. Second, determine the population, determine the sample size, and define the sampling population. And those are the explanation of each of those when we doing the planning. This is the planning of the audit. Which one is what exactly we're doing in every single level. That's why I'm going to stop here with chapter 8. On chapter 8, again, I'm just giving you idea, but we're not going to go deep on this chapter because at some point we have to stop with this. Now let's go to the next chapter, which is chapter 9. And that's chapter 9. Let's see what's most important here for the audit sampling on the application of substantive testing on the counting balances here. Again, the only thing that we're doing is using the statistical concept. We're going to chase desired confidence level, tolerable misstatement, and estimated misstatements. That's what we're chasing here. Anything interesting here on the planning level? Again, on the planning level, that we have to do is we're chasing the test objectives, define the population characteristic, determine the sample size. Then we're going on the performance. We're going to select the sample items and perform the audit procedures. And evaluation will be calculating the extrapolated misstatement and draw the final conclusion. Is this actually affect the outside user's opinion or not? And then we're going one after another for the definition of all of those with the explanation. Again, I'm not gonna go over this. So where I'm gonna stop is at some point we have to start doing something today, and that will be on the next chapter when we're gonna start going over the processes in the company. Remember, we have, I believe there are 5 processes. One was the revenue profit. The first one is the revenue process. That's where I'm going to spend a little bit more time today. So, revenue process. Now, the revenue, everything comes with the revenue. One of the, again, if you want to catch what's happening in the company, chase the money. And the first thing that you have to chase is from where the money coming from. And they're coming from the revenue. So what we're gonna do, and we're gonna go and check anything related to the revenue. So what is the revenue? Obviously, revenue is defined as the inflow or other enhancement of assets of the entity or the settlement of the liability or combination of both from delivery or producing goods, rendering services, and other activity that's constitute entity major or central operations. So we're chasing the again, the revenue is related to the main operation of the company, the sources that they're doing, that they're receiving either through selling goods, either through providing services, which are part of the main operation. So what we're going to do first, we're going to identify, do we have a contract with the customers? So basically here we're chasing International Financial Reporting Standard 16, I believe, contract with the customers. That's why sometimes in the cases you can see that there's a problem with the revenue recognition. So basically you have to go establish that the International Financial Reporting Standards, that's for the public company, is actually the requirements are met, and we have a rights to recognize the revenue. Once we do that, then we move it on the audit. And we're gonna, on the audit, first step is to identify, is the contract with the customer actually exist? Second, to identify the performance obligation in the contract. Third one is to determine the transaction price. Allocate the transaction price to the performance obligation in the contract. How much of that price can be recognized now? How much can be deferred? What's the deferral? And the last one, you recognize the revenue when the entity satisfies the performance obligation. Don't forget, in here we have two things. We have recognition versus realization. A realization is when the money are received. Recognition is when the risk is transferred. So let's go with this one. First one we're going to do for the fraud and the fraud risk in the revenue recognition. We may have a side agreement, some agreements which are not part. I mean, like let's put it this way. In the company, I'm going to give you a direct example here. On the last, let's say, on the architectural company, you have let's say 5 architects which work, right? Every each of them dealing with its own clients, but some of them decide to pull one of the clients and to do those the contract with the client to do it outside of the company. So basically, he start doing a side agreements. Next one will be channel stuffing. Then we're going to have a related party transactions. Related party transactions will be okay, I'm hiring my one of the owners hiring his son, which he pays excessive amount of money, which he's in the high school and has no what qualification to do any of the work that he's paid for. And bill and hold sales. So basically, we're going to chase is the sales actually built or is the sales a hold. So how are we going to do this? First, we're going to chase the cash. And second, we're going to chase the credit sales. Again, window revenue, we have two type of sales: cash sales and credit sales. You may have both in the company. You may have only one. If we're dealing with a restaurant, we chase only the cash sales. If we're dealing with like a architectural company or anything else, that will be credit sales. So you have to see, once you get familiar with the business, then you're going to identify from where most of the sales coming. What is the source? Is it like a cash sales or a credit sales? You can have combination of both, obviously. So the type of transaction, what we're going to chase is the 3 type of transactions that typically process through the revenue process. First one is the sales of goods and services for cash or credit. Second one is the receipt of the cash from the customer in payments for the grocery and return of the goods to the customer for credit cash. So again, we purely chasing the revenue. We have a cash sales, we have a purchase, we have the inventory, we have the sale. In here we have the purchase, we have the inventory, we have a credit sales, we have the accounts receivable, and then we have the collection. As you can see here in this cycle, we're adding accounts receivable. And then we're chasing the sales of the goods or the services. Is the cash actually received? Either cash, either credit. And if there are any returns of whatever we sold, whatever company is selling. Now, the revenue process affects the number of accounts. There are not that many though. In the financial statements, most significant accounts are sales transactions, cash receipts, and sales return allowances. On the sales transactions, we're going to chase trade accounts receivables, sales, allowance for doubtful accounts, bad debt expenses. On the cash receipts, we're going to chase cash, trade accounts receivables, and cash discounts if there's any. As you can see, allowance for doubtful accounts and bad debt expense are on the level of the sales. And sales return allowances, we're going to have the sales returns, sales allowances, and trade accounts receivables because those are affected there. Now, the trade accounts receivables, as you can see, is related to all those type of transactions. This is the chart flow of revenue. On the different department level. First one will be the entity department, order department, IT department, shipping department. And this is example for the company that's happened. So how the order is made. Now the customers can make the order online or by phone. Then we're curating the customer sales order or the customer directly input on the internet. So once that happened, then we have a data validation of the customer information, or the customer price, inventory, order, anything like that. If there's an error, we bring it back to the input. If everything is okay, then the order is processed. Now, once the product is processed, we chase in the inventory, we have the open order, and then we start the shipping. Then the shipping will be approved, the shipping ticket, ship the goods, and once the goods are received, we're going to get a confirmation that the client actually received the goods. This cycle, you can see it, this is very similar to probably that's applicable to any online purchases that you're making for yourself. On the clothes department, if we're dealing with the clothes, what we're going to have here input and IT department. First, we have the billing department and IT department. So we're going to have this input, billing program, and sales invoice. Before we go to this point, we're going to have the shipping transaction, open orders, and inventory. On the accounts receivables, again, from the sales, we're going to establish the accounts receivables, and there may be some remittance transactions as well. And weekly and monthly, we're going to chase the accounts receivable reporting. And we're going to prepare the level of the reports. Will be daily reports, will be weekly reports, and will be monthly reports. And the last one here is, let me see what exactly is the flow chart of the revenue process on the clothes. So for what's the revenue process here is cash received from the department and where the cash goes. I believe I made too many adjustments here. Let's go back to the original. Here we go. That should be okay now. No, one more. What we're going to have is that from the bank, and what's the flow? From the bank, we're going to have remittances, advanced transactions, accounts receivables, and remittance. Again, if there are any payments that we receive from the bank, those will create the inputs. If the cash remittance is checked, everything is okay. If it's not, then there will be an error. It's going to bring you back to the input of the information. And we're going to have those daily remittances report. We have to check with they have to check with the bank reports is the actual cash has been received in the bank. And then we're going to start working with the type of documents that we have to examine as an auditor in order to, again, to prove that the transaction has been recorded correctly in the company and there's no mistakes in the flow of the information. But as you can see, once you establish understanding of the business, you start creating a picture what kind of processes they have in the company. Now, as you can see here, when you're doing the online purchase order, you're not coming directly to the this chart. But in reality, if you think closely, it totally makes sense. So what kind of documents we're gonna chase? First, we're gonna chase the approval of the credit. Who approves the credit? For the credit sales, entity must have formal procedure for investigating the credit worthless of the customer. So every customer who get the credit, based on what he's getting the credit, who approved the process, everything related to the approval. Customer sales orders. That contains the details of the type and the quantity of the products or services ordered by the customer. So we're chasing how much, what kind of type of service or goods or purchase, and how many of each type. Then we're going to chase the open order report. So basically, do we still have in the system orders which haven't been complete yet? That's going to happen at the end of the reporting date or the end of the when we're doing the when we have to issue the financial statements and we have to express our opinion. Shipping documents, and the shipping documents generally are going to serve as a bill of landing and contain information of the type of the products which are shipped, quantity shipped, are relevant information. Why are we doing all those things? Because we want to see is the goods actually delivered to the customer, because they might be in transit. And if they're in transit, then we have to chase, are they free on board or free on destination? Because if they're free on board, then the risk of those goods are already passed to the client. But if they're free on destination, that means we still have, those goods are technically ours. And during the reporting date, if we have a free on destination, that means those are our goods, and they have to be, even though the sales may happen, we might have received the consideration, the risk hasn't been transferred yet. For that reason, we need to know, we need to find out those documentation, and we have to establish what exactly happened in the company. Again, the sales invoices, that will be for the bill to the customer. We're going to information about the type of the product or the services. So what's the difference? Because we have a what was that? Here we have a customer sales order, which also serve as a kind of have information about the type and the quantity, and then we have the sales invoice. I want you to make a differentiation between the customer sales order versus the sales invoice. Those are two different things. So the document is the issue to the as a bill to the customer. This is document contains information type of the product services, quantity, price, and terms of trades. So basically, the sales invoice has to match the customer sales order. Then we're going to the sales journal. Once the sales invoices have been issued, the sales needs to be recorded in accounting records. Now, from where we're going to see if this actually was recorded in accounting records, from the sales journal. Once the sales is recorded, then we're going to chase the customer statement. That will be the document which is mailed to the customer and contains details of the sales, cash receipts, any credit memorandum transactions. Okay, that will be related to the any return and allowances which are given to that client. Then we're going to chase the accounts receivable, but we're not chasing the main account, we're chasing the subsidiary ledger, which ledger is related to that particular client to which the sales is related to. Makes sense? Because you're going to have one main accounts receivable account that's sitting on the balance sheet, but that's not the accounts. That's the final picture for the accounts receivables. We're going to chase the sub-ledger, subsidiary ledger account that contain account and the details transaction of each customers. That will be, and then once we reconcile all the balances, should give us the final accounts receivable balance on the balance sheet. Then we're going to chase the trial balance of the accounts receivables. And this report will summarize all the customer balances in the accounting receivable subsidiary ledger. Each account is classified as a current and placed into the several past due categories. Past due categories will be 30 days, 30 to 60 days, 60 to 90 days, and over 90 days. Then we're going to see this remittance advice. It's usually part of the customer bill that should be returned with the payment. And after that, once we do this, the next thing we're going to start chasing the cash and cash receivables. Cash received journal. Once we receive the cash actually came. Credit memorandum if they're credit related to the sales or the client get the credit. If there's any write-offs, what is the authorization? Who authorized the write-off? And those are all the types of documents that we're going to chase in order to be satisfied with the revenue cycle. So let's go now and to see which are the major functions of the revenue process. First is the order. First comes the order, which is the acceptance of the customer orders. Credit authorization, approval of the customer order for credit worthless. Shipping, now we're going one after another to all the documents that we already covered. Again, repetition of all the documents as you can see. Credit authorization, shipping, billing, credit receipt, accounts receivable, general subledger. And then we start with the order entity, individual function of the receiving now we're going to go over the one after another to see what exactly we're chasing there. Entity or order entity is the initial function of the revenue process, is the entry of the new sales order into the system. That drives the revenue. That drives the sales order. So then we're going to start chasing credit authorization, shipping, and billing. Cash receipts, accounts receivables, and general ledger. So basically, on the segregation of duties, we're going to see, is the segregation of duty actually exist in the company? And we're going to see which doing which function. Is there on the acceptance level of the order, on the approval level of the order, and sometimes you may even have authorization of the order. And you can see now the order entity is done with by one department, then we're going to the credit approval done by the credit, shipping is done by who's doing what. If everything falls in one category, that means there's no segregation of duty. That means the risk is high, misstatement is high. Then that means we have to increase in order to bring the audit risk on the level that we want to be, we have to lower the detection risk. We can lower the detection risk by putting more procedures, and but that's going to affect the audit planning. What could happen? So let's see this. Let's think about this. What could happen as a result of not having sufficient segregation duty? Tell me now. What do you think is going to happen if we don't have sufficient segregation duty? Again, everything falls in one category. One person or one department doing all the activities. What's going to happen?
There are less, it's most possibility for error because
Watch this. Watch this.
if
One
just
person,
one person did everything.
yes, one person get the order, one
Yeah.
person doing the credit authorization, the same person doing credit authorization, the same person doing the shipping, the same person doing the billing, the same person receive the cash, the same person dealing with accounts receivable, and the same person recording everything into the general ledger. What's going to happen?
There are risks for errors or for some fraud.
Fraud.
Because there
Most
are no
likely fraud. Right?
Yeah,
Most
he might
have
can
the
play
complete control for the
all
money.
along with the transaction, Prof.
yes. So you understand, but now depends. It all depends because watch this. If the owner of the company is the one who's doing all those things by himself, what's his motivation? Right? That will be the thing. Now, if the owner of the company hires somebody to do and that somebody doing all those things, then yes, there's an opportunity for fraud. Right? We just give him everything. So if he has a incentive or if he has a pressure from outside, then he has an opportunity and he can realize that opportunity. But if the owner of the company is the one who doing all those activities, why he's doing all those activities? To work in the best interest for himself. Make sense? If it's the one man operation, which that man happened to be the owner, then is he gonna steal from himself? Do you think?
No.
No. No, in that case, it might be even beneficial he to do everything.
Yeah, but in the same case, it's most difficult to detect some error because he's doing everything. And if he have some error, he will do
Exactly, but
the error every time. Yeah, the
yes,
same error.
yes, but listen this. Then on the time of the audit, if we catch that error, so because there are two type of errors, so you have to understand there are two type of errors. One error is when there's a consistent error, right? And there's sometimes you have to I don't know, if you have a chance, become a controller of the company and then monitor the other people, and you're gonna see very interesting things about the errors. Depends on the motivation of the person, and depends on personal knowledge, and depends on the errors. You can understand what kind of person you're dealing with. If the errors is consistent and repeating it over the time, that means that person lacking knowledge. So that means once you fix that, once you explain to the person, and once that error is fixed, that error is never going to happen again. Right? That's the error that usually I want to see in the operations. Matter because of lack of knowledge. And once you fill the gap of the knowledge, that error disappears, but disappears like forever. The error that I don't want to see, and I hate when I see it, is inconsistent error. That means, the error that happens here, then repeat himself then it's fixed for the few periods, and then happen again, and then another error happens somewhere else, and that error is also, there's no consistency now in the error. So that means the person who's doing that is either having too much knowledge and testing the system to see when the error is going to be caught, and he's looking for some opportunities, or the person that doing whatever he's doing, he doesn't care. And if you're dealing with that situation that the person doesn't care, that's the worst case scenario, right? From all the errors, if I have to, from my experience, this error is the most difficult error to fix, and you're never going to be able to fix it. When you see inconsistent random errors appears from random periods, and then disappear, and then appear again, and then disappear. So that means the person who's doing whatever he's doing, he doesn't care. It's very hard, very difficult to motivate those people, and very difficult to fix that kind of error. But on the segregation of duty here, it's yeah, you create the opportunity here. But again, if the person is the one who's doing his own business, working his own interest with the whole idea to generate revenue, he's never gonna steal himself, unless we're going to the movie The Accountant First part, and he referred to the Crazy Eddie or Panama pump case. If you take a look on the history, and you're gonna find the Crazy Eddie Panama pump case, it's very interesting case. In terms of understanding what the person was doing, he was doing his own company, and what he started doing is in order to reduce the taxes. He was dealing with the taxes. His motivation first was the taxes. In order to reduce the tax, to save money on the taxes, he started stealing from the company, from his own company, right? By reduce the revenue, and he flipping the money from some other accounts, until later he can come up with better idea. And he start putting the money back in the company, and he actually generating more profit. But I'm not going to tell you exactly details. If you are interested, take a look. It's very interesting way, and I want you to know those things. I want you to know. I really want you to understand and have time to spend of what people doing and how they're doing it, because that's going to help you to cut the opportunities. If you have to cut the opportunity, if that happened to you, and you never know where you're going to end up and what you have to do. I wish all of you become powerful controllers, which are dealing with the multi like a country organization and international companies and dealing with all those things. And so then you have to be, how can I say, you have to start seeing out of the box in order to catch things that happen and understand what's actually happening. So let's go with the inherent risk assessment. So inherent risk is the risk that we have and there's nothing we can do about it. Don't get me wrong here. On the inherent risk, we're just assessing it. We cannot reduce it. We cannot increase it. It is what it is. Now, the question is, can we see it and can we evaluate it correctly? That's what our risk is. So there are 4 inherent risk factors that may affect the revenue process. First one is the industry-related factors. Second one is the complexity and contentiousness of the revenue recognition issues, difficulty of auditing transaction and audit account balances, and misstatement detected in the prior audits. So how are we going to assess the control risk? First, we're going to understand and document the revenue process based on the whatever strategy, the reliance strategy. We're going to plan and perform tests of the control on the revenue transaction, and we're going to set and document the control risk for the revenue process. That's how we're going to assess the risk. Now, first we're going to get with the understanding. From where we're going to get the understanding? First, we're going to chase. Now we're chasing. Once we understand the inherent risk, the next one, remember, is the control risk. And we're chasing the internal control. We have to get the understanding of the control environment. Then we're going to get with the entity risk assessment process. Audit must understand how the management actually consider risks that are relevant to the revenue process. And then we have to estimate the significance of the risk and the likelihood of that happening. Then we're going to start documenting the internal control, procedures, narrative description, internal control questionnaires, flow chart, everything that's related to the internal control and activities which are done on the internal level. So we have to get to our knowledge, the process by which sales cash receipts and the sales returns allowances are initiated, flow of each transaction from the initial inclusion to into the financial statements. So we're chasing the flow of the transaction from the first entry all the way to the financial reports. Then we're going to find the accounting records, supporting documents, accounts that are involved in the sales, cash receipts, and cash sales returns. And then we're going to get the process used to prepare estimates for the accounts such as bad debt and sales returns. And then we're going to start chase a little bit on the monitoring of the control is during the process, during the year, we can monitor the process in the company. So in that case, we can monitor the control. And so how that's going to help the audit? The audit is going to help us in terms of the detection risk. If we're monitoring constantly the company and we are satisfied with the control that they have in place to minimize the risk of a material misstatement, that's going to help us at the end of the audit. So we have to understand how the management assess the design and the operation of control in the revenue process. This understanding should be included in how the supervisor personnel review the personnel who perform the control and evaluate the performance of the entity IT functions, because Now everything is related to the IT system of the company. Let's start to the plan and perform the test of the control. Obviously, systematically, we have to examine the entity of revenue process. So in order properly to set the control risk, auditor must test the control over the revenue process. How are we going to do that? We're going to ask for the client personnel. We're going to inspect the documents and records. We're going to observe the operation of the control. We're going to walk through the process and documents, and we're going to check the performance of the control activities. Are those activities actually meet the objective of the what they created on the first place, and are they actually reduce the risk? Then we're going to set up documents for the control risk. If the result of the test control supports the planet level of control risk, then auditor will conduct the planet level substantive procedures of the audit balances. Again, the whole idea is we doing the first assessment, we planning our audit, then we testing the audit, testing the control. If that testing is successful, that means we can continue with our original plan. If the test is unsuccessful, then we have to make adjustment of our original audit plan. The level of the control risk for the revenue process can be set up using the either equation, or quantitative amount, or qualitative terms such as low, medium, or high. And then we're going to the assertion level. That's why I want you to know the assertion levels right in the beginning, because when we start going over the processes in the company and audit those processes, we're going back to this assertion level. So what will be the assertion level of the classes of transaction and events? Occurrence. For the occurrence, all the revenue cash received transactions and events that have been recorded or disclosed have actually happened. As such, transaction and events pertain to the entity. Means actually are related to the entity. It's not like you're recording the revenue, which is for the other company. Completeness. All the revenue cash received transactions and events that should have been recorded have been actually recorded. And all the related disclosures that should have been included are actually been included. Authorization. All the revenue cash received transaction and events can be properly authorized. Accuracy. Amount and other data related to the recorded revenue receipt transaction and events have been recorded appropriately. Relevant disclosures have been appropriately measured and described. Cutoff. All the revenue cash receipts and events have been recorded in the correct accounting period. Classification. All the revenue and cash receipt transaction and events have been recorded into the proper account. As you can see here, we're measuring the accuracy of the related to disclosure. We're chasing here the event has been recorded appropriately, but on classification, we're chasing are they recorded in the proper account. And then presentation. So that's why you have to understand and feel what the accuracy means, what the classification means, and what we're chasing when we say accuracy, what exactly we're chasing, and when we say classification, what actually chasing. Because those are, for me, those are kind of confusing, if you ask me. But once you understand what the accuracy is, the chasing here appropriately recorded versus recorded in the proper account. That means here on the appropriately recorded means the amount of the quantity, time of the single price comprise the total price, and the total price was actually recorded, not something else. That means accuracy, appropriately recorded. Whether on the classification is now that amount that we come up with from the accuracy level, was it recorded to the right general ledger account? Which general ledger account then have to communicate with the account which is sitting on the financial reports. So all the revenue, cash receipts and events appropriately adequately are aggregated or disaggregated and clearly described and related disclosure relevant on the understandable context of the requirements of the applicable financial reporting framework. So that amount that is actually the accurately calculated, properly put in the right classification, is actually belongs to that particular element of the financial statement. And then we start chasing here examples. This one is more practical now. I mean, this actually tells you exactly what to look for on the occurrence level. What's the possible misstatement? What's the example of the control activity? And what's the example of the test of the control? Now it become interesting. This is the part actually of the audit that I personally like the most when it comes to the actual application of everything that we're talking about with action. So as you can see on the occurrence, what we're chasing here, we're chasing the fictitious revenue or revenue recorded, but goods are not shipped and services are not performed. What will be the example of the control activity which can eliminate that is misstatement? Segregation of duty. Sales order only with the approved customer order and the shipping document. Accounting for numerous subsequent sequences in the sales invoice, numerical sales invoices. So basically, if you put all the sales invoices in the right number, and then the chances you to issue fictitious revenue are very small. Why? Because you're using pre-numbered invoices. You know, in my country of origin, so listen this very interesting fact, which I have it interesting here in Canada. In my country of origin, before you issue the invoice to the client, all the invoices have to be approved by the local revenue service. So you're going to the local revenue service, you register your invoices from which number to, from that number to that number. And after that, when the revenue service to the audit, they chasing those numbers of the invoices. And if you have issued other invoices on your behalf, which don't have the particular elements on the invoice, so every invoice has to have a stamp of the company. You cannot issue invoice without stamp. There's different requisites on the invoices that has to be on the invoice. And if those are not, then you're subject to penalty. That's how you're achieving this numerical sequence in the sales invoices. Where here in Canada, that doesn't exist. You can issue any kind of number of the documents. Now, obviously that's why for the audit purposes, one of the things to chase in the when you're doing the control of the audit and assessing the risk is to see is the actually company have approved policy of the numerical or sequence of the sales invoices. Then we're going to chase the monthly customer statements, complaints handled independently. Those will be the examples that the possible misstatements that doesn't exist. And how we're going to test the control. Let's say for the segregation duty, we're going to do observation and evaluation of the process of the segregation of duty. How we going to chase, for example, the fact that they have a numerical sequence of the invoices. We're going to review and test the client procedure for the counting of the numerical sequences in the sales invoices. If the IT application is appropriate, then we're going to do the examination of the application control. What we're going to do is very simple. We're going to get from the accounting software, we're going to get the numbers of in the system of all the invoices which are issued or entered in the system. We're going to organize it by the declining order or from the lowest to high number. And we're going to see is there any missing numbers. We can easily find those ones in the software, or the software is going to tell us right away. And then we're going to the completeness, and then you can see here we have again different example, which is the possible misstatement related to the completeness. Then we're going to move to the possible misstatement related to the authorization for the accuracy. I'm not going to spend too much time here on this one, but I want you to go over those ones and to see what's the possible misstatement for the accuracy. Let's go with the accuracy. Revenue transaction recorded in the incorrect dollar amount. How are we going to examine this one? And what kind of control they can put in order to eliminate that one? Authorized price list with the specified terms of trade. And each sales invoice agree to the shipping document and the customer order. So how are we going to example this? Same as above. That means that comparison of the prices, terms of sales invoices to the authorized prices list in the terms and the trades. Our examination of the sales invoices for evidence that client personnel verify mathematical accuracy. Recomputation of the information on the sample of the sales invoices. So basically, we're going to pull, so we're going to prepare a sample based on the number of the documents that they issued during the year, and we're going to say, okay, out of we're going to see how many invoices they issue. Let's say they issue 10,000 invoices, and our sample will be probably 5% of the invoices, or 10%, depends what you. So you come up with the number of the invoices, and then randomly pick invoices from different periods, and try to see on those invoices that you pick, is the calculation correct? Is the price, sales price, is actually correct sales price? Is the items that have been on the invoice that matching the shipping documents that actually the item that was actually shipped? And that's how you can do that. There was I don't know if I told you. I mean, usually when I'm teaching inventory, I'm telling this. There's a Molson Canadian. If you once you pass the Burrard Bridge towards going south, on the left side, there's a Molson Canadian factory, or there used to be. I don't know if it's still working, but anyway, there's a Molson Canadian factory. Now, in that factory, there was a scam going on, and the scam was related to the term was collusion. Means that So many people were involved in that one, but apparently, because they're working together, nobody caught it for a number of years. So what they're doing is on every trail with beer that going out of the every truck that going out of the factory, there's one pallet full of like a beer. You know, imagine those pallet, one pallet which is not accountable, and they were running that scam for more than 20 years. And nobody caught them. And accidentally, by mistake, they caught them by mistake. Not because of the audit procedures, not because of the chasing the accuracies, not because of the samples, nothing of those can caught them. They caught them by accidentally. So let's see what the cutoff. Let's see the classification. Classification, the possible misstatements, the revenue transaction are not properly classified. So what we're going to do now, we're going to chase the chart of accounts. So now we can see the distinction between the completeness, no accuracy, sorry, accuracy and classification. On the accuracy, we're chasing the proper amount actually put on the invoice in terms of calculation. Where in the completeness, we're chasing the chart of accounts and properly coded to the different type of products and services. How we're going to examine those revenue review of the sales journal and general ledger for the proper classification, and examination of the sales invoices for proper classification. And if the IT application is applicable, then we're going to test the application control to the proper codes. And the last one is the presentation, where is the revenue transaction not reported, properly presented and disclosed. Again, we're going to chase chart of accounts. And then we're going to do the examination of the sales and invoices, also the examples of the test control. So as you can see, very explicit, very extensive overview of the control procedures on the level of assurance and how we're going to chase the possible misstatements, examples of control, example of the test, activity control activity, and how we're going to test how those activity actually work. So once we go through this, what's the next? What happened is we try to talking about now the occurrence of the revenue transactions. So the auditor is concerned about the two major type of material misstatements: sales of the to fictitious customers and recording revenue when the goods have not been shipped, when service has not been performed. So what we're chasing here, we can easily chasing for the hiding the revenue or putting the revenue that doesn't exist. And what will be that? That will be probably money laundering. That's what we're going to do. We're going to create a sales for fictitious customers, which doesn't exist, in order to pump the money in the company, which you're going to clear. That will be one thing. So auditor will need the assurance that all the recorded revenue transactions are actually valid. Completeness of the transaction will be the major misstatement that concern both manager and the auditor, is that the goods are shipped or services are performed and the revenue is not recognized. So everything has been done, but there's no revenue. Which are the control accounting for numerical sequence of the shipping documents and sales invoice. So now we're going to trace both sales invoice with the shipping documents to see is the shipping document, if the goods are shipped, and then we're going to chase the once they shipped, then we're going to chase is their sales invoice. Once we find the sales invoice, then we can easily trace the sales invoice and find the sales invoice Is it kind of recorded in the system or not? Then we do the matching shipping documents with the sales invoice, reconciling the sales invoice to the daily sales report, and maintaining and reviewing the open order files. So that's why in the very beginning, if you remember, we're chasing the open orders. Why we're chasing the open orders? To see is that for the open orders, which hasn't been complete yet, but if the sales invoice, that means we're recording a revenue for which the goods and services hasn't been delivered. Authorization and the accuracy of the revenue transaction. Now, the possible misstatement will be due to the improper authorization, which including the shipping of the goods or performing the services, the presence of the authorized price list and terms of the trade, those reducing the risk of the inaccuracies. And those sales invoices should also be verified for the mathematical accuracy before they send to the customer. So basically the software that we're running should accurately calculate the, let's say, hours time the rate per hour and come up with the correct calculation. And obviously once the sales invoice is created, and obviously we need that sales invoice to be matched with the cost, but we're going to come to that one a little bit later. Cutoff and classification of the revenue transaction, that will be the possible sales may be recorded in the wrong accounting period. Why? Because we want to shift the revenue from one period to another period. Then all the shipping documents should be forwarded to the billing department on the daily basis. And once that is done, then we're going to chase again free on board and free destination, what exactly is and how this work. The use of the chart of accounts and the proper codes recording the transaction should be provide adequate assurance about the proper classification on the. So we're chasing those coding and authorization of the transactions. Now, presentation of the revenue transaction. Auditor will test the control around the management use of the chart of accounts, proper codes on the revenue. So we may have a different type of revenues in the company. It doesn't have to be only one revenue. It may have different type of revenues. Now, but that will be for the company kind of additional information. So if that's happened, then the task coding has to be checked by the auditor. Is the revenue going to the right sub-revenue account, if you can say it that way? And then the financial reporting process is properly authorized, and how exactly the information flow from the sales receipts into the revenue recognition through the revenue account on the financial statements, and how the financial statements are actually presented. Because once you have the software, it's very easy. If you don't have the right links within the software, you can link the expense account with the revenue account. So every time when you put the expense, that actually is going to reduce your revenue. It's not going to show as expense. It's going to directly affect the revenue. And that can be a tricky, interesting thing to do. Let's do this. What will be this? Which of the following is most likely to be detected by auditor review of the entity sales cutoff? Not that what I want to do. I don't want to do that. Obviously, that will be lapping of year-end accounting receivables. That's going to go detected by the auditor review. Excessive sales discounts, that will be that's not going to be catched by the cutoff on the sales cutoff. Unrecorded sales for the year, that's going to be spread through the year. Unauthorized goods return for credit, that's also going to be spread over the years. On the cutoff, we're going to catch lapping of year-end accounts receivables if we have any of those. Now we're going to once we do the on the revenue, all those with the revenue transactions. Now we're going to the next type of transactions which are related to the cash. And again, we start with the different level of assurance. What's the possibility of the misstatement? What's the example of the activities? An example of how we're going to test the control over that activity. And again, you're going to see so many different options here. The whole point here is you to understand what's the possible misstatement on each level. And then the examples are just examples. You should be able to come up with examples when you get enough experience in audit, if you decide to go with the audit, and you should get enough examples. Obviously, as you can see, you won't be able to work on all the processes in the company. Most likely, if you're going with the audit, you're going to work with one or two, because again, you have to get a better understanding of the company, and then once you get the better understanding of the company, you're going to have to come up with the ideas where the risk can be, and what will be how you're going to test the control inside of the company in order, again, to reduce the control risk. Because if you don't reduce the control risk, then we have to reduce the detection risk, and detection risk will be chasing more documents. Now, on the occurrence of the cash receipt transaction, the possible misstatement that concerns the auditor is, when considering the occurrence assertion, is that the credit receipts are recorded but not deposited into the bank account. So we get the cash, but the cash is going somewhere else. Completeness of the cash receipt with authorization of the discounts. So basically, we're going to see what kind of actual policy the company has on the discount, and is this policy actually followed. The control in the account system and the data analytics should be ensured that the management policy actually are followed, right? So we're not skipping the policy and changing the policy. On the accuracy of the cash transactions, now the wrong amount of cash could be recorded from the remittance advice, or the receipts could be incorrectly processed during the data entry. Now, to minimize those type of errors, daily remittance report should be reconciled to the control list of the remittance advices. And now, the use of the monthly customer statements also can provide check for possible correct customer count, if we're doing that. On the cutoff and classification of cash receipt transaction, if the entity using the logbox system, and if a cash is deposited there in the bank, which one is it? And there's a small possibility of cash being recorded into the wrong account period. The auditor now random, then we're gonna has a major concern about the cash, or seldom has the major concern about the cash received being recorded in the wrong financial statement account. So basically, we're not too much concerned about that as auditors. And the control activities on the test of the sales return allowances is the sales return allowance usually not a material amount. However, credit memorandum that are used to the process sales return can be used to cover the unauthorized shipment of the goods. So because of that, we should properly authorize the credit credits as well. So basically with the credits, you can also use it for the hiding the shipments. And credits for the return goods should be supported by the receiving documents that, okay, so basically what's happened here is I'm shipping something and then I'm issuing credit notes. That means that the goods has been returned, but they never been returned. Now, suppose that you are auditing entity, let's say a restaurant or bar, that a large portion of the payments are made cash. How would the auditor determine if all the cash was being recorded and not stolen by employees? What do you think? Give me ideas. All of you been in a restaurant. Now, imagine there's no ITM in the restaurant. All the customer paying cash and cash only. How you determine if the cash was being actually recorded and not stolen by the employee? Any ideas? Come on, guys. You've been in the restaurant, right? Can you guys hear me?
Yes.
You've been in a restaurant,
Yeah.
right? Imagine the restaurant, the waiter only get cash, nothing else. No credit cards, nothing, just cash. How would you make sure that the cash actually been recorded and it's not
The
stolen?
order for the order that they give to the kitchen area to check that
Provided.
receipt. I don't know.
The receipts, no?
Yeah,
Re-
maybe by the receipts.
Okay.
Versus to receive the orders in the kitchen area that they have
Do you actually pay attention
counter
when you
have
do you? So
versus to the receipt.
question for you. Do you pay attention when you go to the restaurant?
Yeah.
So
No,
no, you don't, right?
no.
So
When I go as a
especially
customer, no.
so listen this. Especially there's some restaurants that they don't accept Visa. They only accept cash,
Yeah.
right? That's those type of restaurants. Now, when that kind of restaurant happen, is usually the waiter is not the one who gets the money.
Yeah, it's the cashier directly.
Exactly. Which cashier directly happened to be one of the managers or one of the supervisor that's sitting there. So first you're eliminating the how can I say the cash movement from one hand to another hand, right? That will be but again you have to pay attention because once you go to those type of restaurants, they probably already have those things in mind. That's why they have procedures in place. So the waiter never get the cash. She's the one who taking the order, going there, tell the order, then bringing the food. And when the customer says, I want to pay, then another person comes with the bill, with the receipt, with everything, and say that much. And he's the one, and usually the one person only take the cash. And usually the cash is taken either from if it's a small restaurant, by the owner of the restaurant, or some relative to the owner of the restaurant. That's how you're eliminating the cash going from too many hands. Make sense? So how are we going to examine this? Well, simply we're going to chase the receipts. Now, the other thing is, now we're going to the other point. Yes, do you have the cash What will be that? The cash automat, right? The cash kind of where when you put the cash, the receipts comes, and when you cut the receipts for the whole the sales for the day, you can compare the cash. But what if you don't have that? If not all the sales are put on the cash receipts
With the inventory.
with the inventory, right? But then on the inventory, it's going to be easy because on the inventory, I can easily say, well, if I'm in a restaurant, well, that's actually, I didn't sell that inventory. That inventory actually perish. So imagine what I can do. I can write off the inventory, which is going to increase my expenses. At the same time, I'm not recording the cash. So I'm reducing the revenue of the company, and at the same time, I'm getting cash free. That's even double thing. Right? There's so many so many opportunities, especially when you're dealing with cash. For that reason, what you have to do, eliminate the cash if it's possible. Don't accept cash, go with the credit cards. But on the credit, if you take the credit cards now, if you take the credit card company is going to charge you the fee, which fee you cannot transfer to the client unless you incorporate the fee already in the price of your items that you're selling. That will be the only way you to transfer that fee. So as you can see, this one, the whole process and understanding the single process in the every single stage of the company creates a kind of thinking. And auditors usually, they're not thinking in the way how to prevent it rather than how to test it. But you as an accountant now, and have knowledge about the audit, you can think more different way in order how to prevent those things not to happen. Right? So now relating a certain assessed level of control and risk, again, we're going to chase auditor testing the control for the revenue processing, impact and detection risk, so therefore the level of the substantive procedure impacted by the control. So we're going to chase accounts receivables, we're going to chase sales, we're going to chase cash, allowance for doubtful accounts, sales return, and the bad debt expenses. Audit or revenue-related accounts, substantive analytical procedures. Those are used to examine the plausible relationship among the revenue-related accounts. And the test of the details will be focused on the transactions, account balances, disclosures. We're going to test the detail, test of the detail concentrate on the ending balance of the accounts receivables and the related accounts, as well as the customers, the related disclosures. Here, then we're going to go with those substantive analytical procedures. Once we go with the substantive analytical procedures, will be receivables turnover, aging category of the age trial balances, bad debt expense as a percentage, allowance of the uncollectible accounts, large customer accounts balances. Those are the typical. I wish you can experience audit, but those are like literally the auditors literally doing textbook. They're asking every time when they enter the company, they're asking for give me the 10 large customers accounts, give me the allowance for doubtful accounts list, analytical list of those, and how you come up with this. Give me the bad debt expense. And then you don't have to give me the percentage of, I can easily calculate the percentage of the revenue. Give me the aging category. They're always asking for the analytical on the accounts receivables on subledgers by the categories. And they're always asking for the receivable turnover. Those they can easily calculate it. Receivable turnover and then outstanding, I can easily calculate those ones. What I need is I need the credit sales and accounts receivable beginning and ending balance. So what we're going to test on the transaction on the accounts receivable. So we saw the revenue, we saw the cash. Now let's go with the accounts receivable. Same idea. We're going to testing the assertion of the classes of transaction on the occurrence, completeness, accuracy, cutoff, classification, presentation. And test of that will be for the allowances for uncollectible amounts. Here we take allowances in the bad debt expenses. That's the same thing with the existence and right obligation, completeness. But here we're chasing first on the quasi transactions on the transaction level. And the next thing is on the account balances. And this is example of H12 balance for the accounts receivables. Again, by customers, and that's actually summary. That's a summary. You can take a detail. On the detail report is going to show you actual. They can be by client. They can be by project. They can be by so many options. And on the detail is going to give you by date and the invoice number and everything, how much is outstanding. This one is just simply summary. If you want, I can show you those one. So you can see the difference between the detail and the summary. This one is clearly summary because it's one line by client. It doesn't give you from where this balance says, okay, I can see the total balance come from 10,000. That's coming from 30 days and for 31 to 60 days, but doesn't tells me how many invoices outstanding, how many invoices are in this period, how many invoices in that period, for which projects are those. Once I have that information, then I can trace it back to the actual invoice and to the actual project. And then once we go to the project, I can check in the project or in the customer level, is the revenue actually recorded? Is it recorded into the project? Is it recorded to the account? So many options. Now let's go with this evaluating the adequacy of the allowance for doubtful account. An audit most likely will review the entity aging receivables to support management financial statements assertion of. So basically, we have to evaluate adequacy of allowance for doubtful accounts. If that's the case, so adequacy, what was the adequacy? Obtain evidence, review, testing, completeness, assertions. That's for the account for doubtful completeness. Tracing sample, shipping documents, details of the sales invoices and the sales journal, customer accounts receivables, sub-ledger. That's for the allowance for accounts receivables. This one will be the completeness will be for the allowance for doubtful accounts here. Review result testing and completeness assertion assessment level control risk. Tracing the shipment documents. Again, that's the same. But let's see in this question again. Evaluating the adequacy of the allowance for doubtful accounts. Most likely review the entity aging receivables to support management financial statement assertion of which one. So with them on the financial statement assertion, and we gonna support which one of the assertion level. By reviewing the entity aging receivable, and that will be valuation and allocation. How exactly was evaluated, how actually was here will be evaluation and allocation, examination of the results, confirmation of subsequent accounts receivable, so examination of adequate allowance for uncollectible accounts. Here we're doing the examination of, there's not here, this is on the account balances. So valuation and allocation is the one that we're chasing here. with the examination of the by reviewing the aging receivables. Completeness. On the completeness auditor, a primary concern is whether the old accounts receivable have been included in the accounts receivable subsidiary ledger and in the general ledger account. Again, simply getting the report by the aged trial balance for the older customers and reconcile it to the main accounts receivable account. On the cutoff, again, we're chasing for the reporting date. Now, what usually the auditor is doing, they're chasing 1 month before the reporting date and 1 month after the reporting date. That's what they usually do. So they want bank statement from the 1 month before and 1 month after. Bank statement 1 month after. So basically, if there are any irregularities, you can catch them through the cash that's coming in. Existence, rights, and obligation. Existence is one of the most important assertions for the account receivables because the auditor wants to ensure that accounts balances are not overstated. So what we're going to do, we're going to ask for confirmation from the third party and confirmation of the major account audit procedures used to testing the assertion. The auditor must determine that all accounts receivables are owned by the entity. This usually not a problem. However, in some cases, accounts receivable may be sold or factored with or without resources. Accuracy evaluation and allocation on accounts receivable should be on the balance sheet at net realizable value. So the auditor must verify the adequacy of the allowance for uncollectible accounts. The first step is to prepare the H12 balance and discuss the result with the current manager. Next is comparison of the last year result. So technically what we're chasing here is how much of the last year outstanding balance was collected during the current year. And if the amount that hasn't been collected, it's we can measure it as a percentage. Was the same percentage apply into the current year as a estimation of, let's say, bad debt expense? Or for the allowance for doubtful account, are we following the same procedure over and over again? Now, with the allowance for doubtful account, the whole idea that usually the accountant's using is this, which in that case is approved by Canada Revenue. Basically, with the allowance of doubtful account, using it to defer your revenue, so you can match the receipt of cash with paying the taxes. Canada Revenue is okay with that because then Canada Revenue try to convert accrual basis accounting into cash basis accounting, and by adding the allowance for doubtful account, that meets our purpose to move from the accrual basis accounting into cash basis accounting. Again, I want you to understand this, and I want you to picture it. What's the purpose for allowance for doubtful account? Again, allowance for doubtful account comes when you have a sales invoice for which you haven't collected the cash. Now that's recorded as a revenue. Means that technically by Canada Revenue you have to pay taxes, but you haven't received the cash. So most of the company, they don't have problem paying cash, paying taxes. The problem is they haven't collected the cash yet. Right? Once you collect the cash, once you're running cash business, there's no problem for you to pay your taxes because you have the money anyway. So for that reason, that's what we have to do as an auditor. We have to understand this and we have to implement it in our procedures or when we're doing the test. The major issue classification related to the presentation, disclosure, and classification are identifying the reclassifying any material contained in accounts receivable. So basically, we're going to see is there any ginormous credits that can impact our audits, segregating short-term and long-term receivable. And to ensure that the different type of receivables are properly classified. On the presentation, we have to ensure that all the necessary disclosures are made in relation to the receivables. So the public accounting firm use some type of financial statement reporting checklist to ensure that all the necessary disclosure are made to each account for the accounts receivables, and confirmation process is direct written responses from the third party. So basically what I told you, I think I already told you, what the auditor asks is the client to send a letter which is prepared by the auditor, and the only thing on the letter is the balance outstanding. So the company has to put the balance outstanding, send it to the client, and client has to return the letter directly to the auditor, not to the client. Right, so the auditor receiving the letter from the third party directly. Same thing like let's say Sanders School of Management want to check your original diploma. What they want is ask your original institution to send us your transcript directly to us, not to you. Right, that's how you eliminating, and that's how you increase the level of assurance in this case. Omitting confirmation, accounts receivables balances for which balances we don't have to send the confirmation letters. For those who balances are immaterial, what will be based on the materiality, where's the amount that we come up with, we're going to assess which is the material, which one is not. So the material you want confirmation, for immaterial not confirmation. Or external confirmation cannot be would be ineffective in that case, and the auditor assess the level of risk of material misstatement, and then based on that he saying to which account he wants confirmation or not. Factor which will be affecting the reliability of the accounts receivable confirmation is the type of the confirmation request, prior experience with the client, and independent respondent. And now we're going to have a positive confirmation. We have a negative confirmation. Positive confirmation was the request that the customer indicate whatever they agree with the amount is actually due by the client. So, but if the client says this customer owe me $10,000 and the customer confirmed that yes, in fact, I owe them $10,000, that's a positive confirmation. Negative confirmation is when the customer responds only when they disagree with the amount due to the client. So basically, usually the client sends the letter, the company owe me $10,000. If the company agree, they're not sending anything back. But if they disagree, then they're sending the letter back. Timing, accounts receivable may be confirmed in the interim date of or the year end. So basically, what you can do is you can do the regular check on the accounts receivable during the period, if this is the existing client, and if it's the new client at the year end, obviously. But with the confirmation accounts receivables, that's a long process. That usually take a month or two. Confirmation procedures should mail how exactly this one is mailed. I believe already tell you the auditor should mail the confirmation request outside the entity facility. Record should be made on the confirmation mail on those return, and second request may be necessary for some cases. So basically, If the customer doesn't respond right away, then we have to send second letter and maybe third letter. In many cases, the exception results from what the referral is the timing differences. And those differences can happen of the delay of the recording transaction or either the client or the customer recorded. So basically what they're saying is sometimes the clients, the client that we're auditing show the revenue and receivables, but since the goods are not shipped yet, the customer hasn't recorded and haven't confirmed the acceptance of the goods. For that reason, he's not confirming yet the accounts receivables. What will be the alternative procedures when the auditor does not receive response from the positive confirmation? Then we're gonna do alternative audit procedures. Then we're gonna examine the specific subsequent cash receipts, examine the shipping documents, examine the other client documents. So what we're going to do, if we don't get confirmation from the third parties, we have to somehow examine the information that we have available through the client only and have to base our opinion only and only based on the client information. And that will be for that reason, we have to use different documents. What will be other receivables? Receivable other than receivable, that will be from other employees, from officers, from the related parties, for not receivables. Sometimes the company, once a small company, there might be transactions between the owner and the company in terms of owner. Now there's an interesting things here going on. One of the things is owner. Let's say owner wants to have money. He wants to invest the money, right? Company, he's working. His company is profitable. No problem with the profit. So what the owner can do is he can borrow money to the company, and company can pay him the interest. That's a classic example of owner using the company to earn some kind of peripheral income, which is pure expense for the company. Now on the owner level, that's extra cash, right? So now what we have to do is we have to confirm that actually those internal loan that the owner gives to the company actually exist. And that will be a little bit interesting to confirm since the owner is personally involved. Evaluating the audit findings. So basically, once we gathering all the findings on the revenue of the cash and accounts receivables, we have to complete the planned substantive procedures, and the likely misstatement of the accounts receivables then we're going to be determined. So if the aggregate misstatement is less than the tolerable misstatement, then we're going to accept accounting as fairly presented. But if the aggregate misstatement is more than the tolerable misstatement, so basically tolerable misstatement will be our performance materiality. Performance materiality, as you remember, is a lower number than the overall materiality. So if the aggregate misstatement is more than the tolerable misstatement, then we are not satisfied with the audit. So the accounts is not fairly presented. And that's how we finish this revenue. As you can see, this one is very, 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 how can I say, detailed and very kind of specific kind of chapter. The same thing is going to happen with the next one. So we're going to go over the revenue. Today we went with the revenue. Next time we're going to go over the purchasing, because the purchasing we're going to catch now from where now the revenue is from where we get the cash. Purchasing is where the cash going out. And the next, there are 5, and the next one will be the human resource management process. The next one is the inventory management process, and I believe that's about it. And then we're going to have prepaid expenses, intangible assets, property, plant, equipment, and goodwill. All those accounts we have to audit those accounts. Now I'm going to stop with the. So again, we're going to go over the purchasing, and we're going to go over the human resource. I'll see if we have to go to the human resource, but we're definitely going to go with the purchasing process and inventory process, inventory management process. For the human resource, probably very, very, very briefly, I'm going to mention that one because I want we to spend a little time on the, I'll tell you which one I want to spend on the latest chapters. Investing cash in the investments, that's not gonna be. I think there's one of the last completing the audit engagement, that will be chapter 70. So we're gonna do the revenue, we're gonna do the purchasing, we're gonna do the inventory, and then we're gonna finish with the completing the audit engagement. So we know what we have to do, and the reports of the audited financial statements. That will be the last thing that we're going to cover in this course. That will be. That's the last few chapters of the legal liability and assurance assertion internal audit services. Maybe I'm going to talk about a little bit internal audit services so you can understand what are other services, because let me see if I can see my screen. So this is the chart that the services that usually the auditor provides. As you can see, the high level of the assertion is the audit. So what kind of audit we have? The compliance audit, forensic audit, audit of the financial statements, and audit of the internal control over the financial reporting. Then we're going to have those non-audit. We're going to have the non-audit reports on the internal control and the financial forecasting. That will be on the test level. And for the assurance level, we're going to have the performance review and risk advisory. So as you can see, the level of, how can I say, difficulty, this is the highest level difficulty, this is the less difficulty. Then the level of assurance here is the high level of assurance, this is very low level of assurance. And also the different how we start, how we hold the process of the outcome and the feedback on the audit process. And I want you to know about the risk or the type of assurance services that the company, that auditors can provide. Unless the audit is your kind of role in CPA, then you don't need that much detail on the assurance services. But I don't know where you're gonna end up. You might end up with being an auditor. And if you end up in the public practice company, then you have to take audit as an elective. In that case, that will be a relevant knowledge for you. Okay, that will be all for me from today. I know this one is again, revenue process is very specific. Again, we're going to focusing on the revenue, on the cash collection, and the accounts receivables. But take a look at the examples. Try to make your assignment more practical rather than dry theory. And we're going to go from there.